Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing BLL Corporation stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. BLL Corporation manufactures plastic and metal food and beverage containers. It is also a manufacturer and supplier to the aerospace industry. The company is headquartered in Westminster, Colorado, and was founded in 1880. It went public in 1973 and currently trades on the NASDAQ. 85% of its revenue is from containers and 15% from aerospace. Its aerospace customers include government agencies and businesses. Let's get started with the model. This is a large cap company, 27 billion market cap. They're trading at $84 a share, and they have 328 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company has a lot of free cash flow from 2017 to 2019, nearly $1 billion. Then it drops to $300 million in 2020. Net income is the profit and loss on the income statement, and that grows every year from $370 million to $580 million. Revenue is the sales for the company. That's also been increasing from $11 billion to $12 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Example is cost of labor. The difference is the gross profit, and that peaked in 2020 at $2.5 billion. Then below that is operating expenses. Example is depreciation. And below that is operating income. That's pretty consistent, from $1 billion up to $1.3 billion, peaking in 2020. Below that is the interest they pay in their debt, which is $275 million. And that's the lowest amount of debt they paid in the past 4 years. Last year it peaked at $317 million. Then below that is other income and expenses, and this is usually impairments or other non-operational gains and losses. Then you have your pre-tax income, then your taxes. And they also have earnings from equity interest. Earnings from equity interest is an accounting line item. These are the gains and losses from its investments in other companies. Usually when a company owns 20% to 50% of another company, then they have to report those companies' earnings onto its income statement as equity interest. That's pretty low. It was $31 million in 2017, and they reported a $6 million loss in 2020. The bottom line of the income statement is their net income. That's nearly $600 million. 2020 was a good year. There was a lot of demand for their products due to COVID. Here's a breakdown of their third quarter 2020 revenue. They had $3.1 billion of revenue in the quarter. $1.3 billion is beverage packaging in North and Central America. $800 million is from Europe, Middle East, and Africa. $400 million from South America, and $450 million is from aerospace. When you compare those numbers to the prior quarter of last year, they're up in every category. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. It's good to remember net income is your accounting profit and loss. It's not actual cash. Operating cash flow is net income converted to cash. Then you have capital expenditures, which are investments in property, plant, and equipment. You can see their CapEx was really high in 2020. That's why they had low free cash flow that year. Not because they had low operating cash flow. Their operating cash flow is pretty consistent each year. They had high CapEx, so they had only $320 million of free cash flow, 1/3 of 2019. They paid about $200 million of dividend payments in 2020, but another way to reward shareholders is to buy back stock. When a company buys back stock, this decreases the shares outstanding, making your shares more valuable. They bought back $100 million then 700 million, then almost $1 billion, then 75 million. They issued $700 million of debt in 2017 and paid down $1.8 billion. So they paid off over $1 billion of debt that year. They paid down a little debt in 2018. They issued about $1.3 billion of debt in 2019. That could be to acquire another business. They paid down about $250 million in 2020. Ever since COVID, this company's demand has been really high, so they have a backlog of orders and new projects. That's why their CapEx was so high in 2020, and it could be even higher in 2021. But if the investment in CapEx pays off, their revenue could grow a lot faster in the future. Let's look at the capital structure. $3 billion of equity, $8 billion of debt. They're 29% equity, 71% debt. Their net debt is $6.5 billion, and their WACC is 5%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $40 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $36 billion. We divide that by 328 million shares. And we get a calculated stock price of 110. They're trading at 84, so they're trading at a 24% discount. It's a buy according to the model. Simply Wall Street values the company at $93. They're also saying the stock is undervalued, just not as much as me. 6 analysts valued this stock in the past 3 months, and the average price was 106. The low was 100, the high was 112. My valuation is between their two numbers, closer to the high. This is the stock price the last 5 years, and it doubled from 2016 to current day. It looks like the stock peaked at about $95 a month ago, but it's come down a little bit. They paid a 7-cent dividend in 2016, now it's currently 15 cents. Their dividend yield is 0.72%. To calculate the dividend yield, multiply their last dividend by 4, take that number, and divide by the current stock price. So as the stock price goes up, the dividend yield goes down. And as the stock price goes down, the dividend yield goes up. They pay out 34% of their net income and 62% of their free cash flow. The industry average is 1.9%. They are much lower than that. The bottom 25% of the market pays a 1.3% dividend yield. So they're in the bottom 25%. The forecast in the next 3 years is a 0.8% dividend yield. And they have a low beta, 0.42, so the stock moves half the market. The stock has gone up 30% in the past 52 weeks, while the S&P 500 went up 65%. The 52-week low was 51, the high was 103. And the stock is trading below its 200-day and 50-day moving average. About 2 million shares are traded each day on this stock, and of the 328 million shares outstanding, 326 million are on float, 86% are held by institutions, and 3% of the shares on float are shorted. If you include dividends, in the past year, the stock has gone up 30%, the industry is 60%, and the market is 72%. In the past 3 years, the stock has done really well, up 115%. The industry is 41% and the market is 57%. In the past 5 years, Bull is up 147%, the industry 97%, and the market 120%. Analysts are forecasting their earnings to grow 11%, the industry 21%, and the market 19%. Their revenue they're expecting to grow 7.5%, the industry 4.4%, and the market 10.1%. If you invested $10,000 into this company 10 years ago, you'd be at $54,000 today. That's an 18% annual return. The biggest shareholder is Vanguard at 11%, then BlackRock, T. Rowe Price, State Street, and Managed Account Advisors. Let's look at their financial ratios. The average PE in the market's 8.4, the median is 13.7. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 46.8, so investors are paying $47 for $1 of earnings. Price to sales is stock price over sales per share. They're at 2.3, which is a really good price to sales ratio. Price to book is stock price over book value per share. They're at 8.4. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities in the balance sheet, and they have $3.3 billion of equity, negative $3 billion of tangible equity, because they have $6.4 billion of intangible assets on their balance sheet. A company gets intangible assets on its balance sheet when they acquire another business. Interest coverage ratio is EBIT over interest expense. They can cover their interest payments 4.5 times. ROE is net income over equity. They have a really good ROE at 18%. Current ratio is current assets over current liabilities. They're at 1.1, so they can just cover their current liabilities with their current assets. Their current assets are $1.4 billion of cash, $1.7 billion of receivables, and $1.4 billion of inventory. They do seem to have enough capital to get through the next 12 months without needing more debt. They had over $300 million of free cash flow, which is low for them due to their high CapEx. They have over $200 million of working capital and a $200 million dividend payment. So they have $350 million of funding. The best way to look at ratios to compare them to companies in the same industry. I've done videos on Reynolds Wrap and Tupperware, both in the same industry as Ball. And if Ball has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're worse than all the price multiples. They do bring in a lot of revenue, so they only convert 3 to 5% of that revenue into profit. That's why they have a high PE. They do have a high price to book relative to the average, but the average is skewed with Tupperware having a negative price to book. They have a good current ratio, it's above 1. They have a good ROE at 18%. Reynolds is a little bigger, and they're in the middle market cap at 71%, average is 76%. And they're by far the biggest company of this group. If you combine the other two market caps and triple them, they're still lower than Ball. Ball does pay a dividend, but is a lot lower than Reynolds, and Tupperware doesn't pay a dividend. To summarize, I have them trading at a 24% discount, and this company has been around a really long time. What the company did in the 1880s is obsolete now, but they've evolved and are still generating lots of revenue and lots of profits. Plus, with COVID, people want things that are sanitary and clean. Their canning products help people do that. That's why they're in really high demand and they can't keep up with orders. So I could see them growing a lot more in 2021 and 2022. Because even if COVID goes away, people are going to be more sanitary than they were before. I rank their free cash flows 5 out of 10, their revenue 7 out of 10, and their ratio is 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.